Hey, Jim.
Hey, Jan. If you could tell me what deflation and the inflation is and the relationship between the GDP and inflation.
Okay, good, great. Here's the difference, first of all, of inflation and deflation. Inflation, of course, is prices rising. We would look at gasoline right now and say that we are in a deflationary period of gasoline. Now, on the surface, Jim, it looks pretty good. Well, I like that. And deflation generally indicates a very weak economy. What happens is if you sell some sort of product, or if you're in the construction contracting business, or you are a service company in some way, shape, or form, in an economy that is struggling, nobody is buying your products or using your services. And the only way that you can survive, and this goes for large corporations as well as, small sole proprietorships, it gets to the point where the only way you survive is by lowering your prices. So you end up doing things for practically nothing so that you can survive and that people will buy or use your services. That's what happens during deflation. So when we see deflation, it generally means that the underlying economy is bad and people aren't buying anything, so prices continue to get lowered to a point to try to encourage people to buy so that businesses can stay afloat. And that's a little bit. I mean, it seems a little simplistic, but it's really not a whole lot more complicated than that. Inflation, of course, is the opposite of that. Economy is doing better. Prices are going up. Now, sometimes inflation can happen during a period of poor economic times, because what can happen is there's a destabilization. Maybe something's going on in the economy. We can have inflation in oil prices, for instance, as a result of a war or a geopolitical event, which can drive the prices to truckers up, which drive the prices of food up, getting to the market, which drive the energy, driving the prices of a lot of construction materials that are energy dependent, siding, shingles, insulation, that they use an enormous amount of energy to make those products, drives those prices up, and it trickles through the economy. That's called, that's inflation. So that doesn't always have to show a good economy. That can also show a struggling economy in one particular area that we're seeing inflation kind of get out of hand and out of control. So that's inflation is driving prices up. So inflation is a good thing in small portions. Inflation, a little bit of inflation, is good because it helps companies make more money. If companies make more money, they hire more people. That's good for the economy. When they hire more people, it lowers the amount of people looking for a job, which means we start to see wage growth. So a little bit of inflation usually means, hey, this is a good, stable economy, things plugging along, and we're having some inflation. That's good. That lifts all boats, so to speak. So that's a good thing. Inflation is absolutely necessary, especially right now, because we have so much debt that it is critical that we have some inflation. What happened during the Jimmy Carter years was Paul Volcker said we got to have inflation to generate some GDP growth, not because it was generating activity in the economy, but because the things that were in GDP were valued at a higher rate because of inflation. So it takes a $14 trillion GDP and makes it $14.5 trillion with a little bit of inflation. When that happens, it lowers the ratio of debt against that GDP. That's a good thing. So GDP growth with inflation is critical for us because we have so much debt. And the Fed will work to raise inflation since they can't get GDP growth.